Hey there, welcome to Kneppyinvests. I'm going to have a peek or a look at Myer and their financial year 22 results. I tried to look at most companies on the ASX that are profitable, and to be honest, there's not many of those companies when you compare to the overall amount of companies that are listed on the exchange. So there's well over 2,000 companies that are publicly listed on the ASX. And I would say maybe 20 to 30% of those companies are profitable. And a lot of those companies you can ignore, or maybe not ignore, but just have a quick look. Typically, when Myer do release their financial results, I will have a quick look. And over the past few years, at times, this company has looked cheap. And Myer right now is looking interesting, not based off their financial results, but based off the valuation and also the chart. The share price is moving in the right direction. So we'll have a look at all those in this video today. Would I consider Myer to be a high quality or a low quality company? Now, there would be many commentators, professional commentators, amateur commentators who would not even look at Myer. They believe this is a dying company with a dying business model, and I can't really argue with that. However, the market overall also believes that, and the valuation of Myer is quite low. And the question is, how much time in terms of years can Myer keep on going? I saw yesterday, I read an article that David Jones in, I think it's the Mount Gravatt Garden City Westfields is closing down, and there's going to be like 10 to 20 specialist stores put in its place. And that is the business model that Myer is contending with. Less and less people are using Myer, going into Myer. I still think it has quite a few years ahead of it. And when I say quite a few years, I mean decade, say 10 to 15 years at least. So even though I do think this is a business model that is on the wane, I still think Myer will be able to produce sufficient cash flows, sufficient dividends to keep their current shareholders happy. And probably I should have mentioned, I would consider Myer to be a lower quality company than a high quality company. So with lower quality companies, I'm more interested in the share price trend. And that is why I'm interested in Myer right now. Now, I am not a shareholder of this company. I have been a shareholder of this company in the past, taking advantage of when the share price is moving up. But I would not own Myer for the long term because all those questions in this company's future. And all those questions the market have about Myer are playing out in the share price of this company. So Myer listed on the ASX way back in 2009. So it was Coles Myer, and then Coles Myer split up or something. I forget the whole story here, but I wasn't interested in any of those companies back then. But Myer share price back in 2010 was around about $4 or just below $4. Current share price is around about 70 cents. So you can just see how the share price has decreased over the past 12 years. And one of the main reasons around this decrease in the share price is the market is skeptical about the business model, and the company's financials are decreasing. So profits decreasing, revenues decreasing, and that are signs for a business model that is no longer, I won't say viable, but hasn't got long left to live. And that is the concern for Myer. However, in saying that, if you do look at this weekly chart, and I have included the moving averages, so the 100-week moving average and the 50-week moving average, there's only been 2 times in the past 12 years where it did look like there was a possible shift in sentiment around this company. When I say possible shift, I'm talking about long-term shift. First time was back in 2013, but there was a lot of volatility back then. And the next time was right now. We are starting to see the share price starting to move up when you look at the long-term chart. And this is telling me there is a little bit of interest in this company right now. But the only concern about that increasing interest in terms of the share price moving up is decreasing interest when you look at the volume, very low volume over the past few years. The really high volume came in just after COVID-19, financial panic. That was the largest volume we have seen, apart from the first week this company listed on the ASX. And I would prefer to see really large volume accompanying or coinciding with the share price moving up. But right now, the share price is at least about a 3 to 4 year high. Just looking at this weekly chart, and we'll have a look at the daily chart later in the video. And that's the reason I have a little bit of interest in this company, is just simply because the share price is moving up. The share price is in an uptrend. The company released a positive trading update, I think that was in May, and that was a catalyst for a shift in sentiment for this company. So those are the only reasons I really am interested in this company at this point in time. That's very important, at this point in time. Now, just because I'm only interested in the share price trend sentiment behind the company doesn't mean I won't be interested in the financial year results for the company. So at a share price of 70 cents, Myer has a market cap of $579 million. Now, one really good thing about Myer is their balance sheet is really healthy. They have net cash and a significant amount of net cash. And that means the enterprise value for this company is only $393 million. So if you don't know how to calculate enterprise value from the market cap, all you do is take the market cap, you decrease the cash and add back the debt. So this company is net cash by well over $150 million. Now, in financial year 22, Myer produced $2.99 billion of revenue, $49 million of profit, but the operating cash flow and the free cash flow was significantly higher than the profit. One of the main reasons behind that is more than likely depreciation, amortization, but the operating cash flow, $136 million, that is after taking into account leases, and the free cash flow was $92 million. That is after taking into account leases and capital expenditure. So this company did produce a lot of cash in financial year 22. So I did mention that, in my opinion, Myer has a healthy balance sheet. So this is Myer's consolidated balance sheet for financial year 22. And the way I look at balance sheets is I just take a quick look at cash, receivables, inventory, so really the total current assets. Also look at the total current liabilities, paying attention to trade and other payables. Also take a quick look at lease liabilities, and then also borrowings, which is also, you might have borrowings in the current liabilities, also the non-current liabilities. But this company had $244 million of cash, but only $58 million of borrowings in the non-current liabilities, which means they have net cash. However, in saying that, this company has significant and really high lease liabilities because they are a retail company and they rent out their space in malls. So $144 million of lease liabilities in the current liabilities section and $1.6 billion non-current lease liabilities. So this company has a lot of lease liabilities, which absolutely makes sense. Now, because I don't include lease liabilities in the borrowings, that's why I determine that Myer has net cash. I do know some commentators, some investors actually include lease liabilities into their debt, which would mean Myer is highly in debt. Now, there are reasons why I don't include lease liabilities in loans, and the main reason is because I believe that rent is a part of the day-to-day business expense of a company. So that's the main reason I don't believe it is borrowings. But some people might completely argue with me, and that's fair enough. Anyway, the second thing is comparing total current assets to current liabilities. So if you divide total current assets by total current liabilities, you get the current ratio. And typically you are looking for a current ratio greater than 1. But for Myer, if you divide total current assets, $649 million, by total current liabilities, $665.7 million, you get less than 1. It's about 0.97 or something like that. Typically, this company always has a current ratio of less than 1. And a lot of these type of companies, these retail companies, have current ratios less than 1 because they have a really high turnover of their inventory. And that is very typical for these type of companies. So even though the current ratio for this company is less than 1, I'm not concerned by that. But if you do compare the current ratio of this company historically, it ranges between about 0.6 to just about 1. And right now, it's just less than 1. So based on just looking at the current ratio, the balance sheet for this company is quite healthy at this point in time. The other thing is equity. So total equity of 267 million. So if you calculate return to equity, and a lot of investors, a lot of commentators absolutely love return to equity, that is just under 20. So about 18 or so. And that is actually quite good for this company. Now let's have a look at the revenue history for Myer. So one of the things I want to see in a high quality company is consistent increase in revenue over time. So I do look at 10 years, 20 years, even 30 years. But when you look at the 10-year history for Myer, revenue has been going down. Now, revenue is on the increase over the past few years, but if you compare the revenue in financial year 22 to financial year 12, revenue has gone down from 2.7 billion to 2.5 billion. We have seen that rebound in the last few years. That does not mean there is a trend. And the main reason you can't say that is a trend because in 2020 and 2021, less people were going to malls, less people were going to Myer. So if you do calculate the total revenue per share change over the past 10 years, that is negative 5.5%. Over the last 5 years, it's negative 2.6%. And over the last 3 years, it's negative 0.4%. So revenue per share for this company is moving in the wrong direction. So again, the market is concerned about the long-term viability of this company, and that's one of the reasons. Revenue is going down, less people are going to Myer, even though the population of Australia is going up. The other thing I've included here is operating margins. So it's really interesting to see operating margins rebound over the past few years, increasing from about 2 to 3% up back to about 2 or 7.5%. The last time we saw operating margins around about 7.5% was way back in 2013. And if you look at operating margins from 2012 all the way through to around about 2018 to 2020, operating margins were on the decrease. And that's one of the reasons why the share price decreased from around $4 all the way down to a low of something like 10 to 20 cents. So another reason to be concerned is whether this company can maintain these operating margins at around 7.5%. Wouldn't be surprised to see these operating margins fall back down to between 2 and 3% over the next few years. And that would mean this company's financial state would actually decrease from financial year 22. So one thing I mentioned was when you compare the profit to operating cash flow, there's a big difference. So operating cash flow was significantly higher than profit. And one of the reasons I mentioned was because of depreciation and amortization. Now, there was a change in accounting standards back in 2019, and that was AASB 16 leases. And in that accounting standard, the rental expense relating to operating leases is recognized within depreciation and interest expense. And the main effect of that is depreciation and amortization from 2019 to 2020 significantly increased from around about 60 to 65 million up to between 190 and $200 million. You can just see that significant increase in depreciation and amortization in that 1 year. That was because of a change in accounting standards. So in this particular slide, I've included cash flow from operations and also depreciation and amortization. But the other effect of this AASB is an effect on cash flow from operations. You can see that between 2019, 115 million up to around about 190 million in 2020, up to 277 million in 2021 and 2022. And that's because of these accounting standards. So the main thing I'm looking for here is just the difference between cash flow from operations and depreciation and amortization. And if you do compare prior to AASB 16 and after AASB 16, that difference between cash flow from operations and depreciation and amortization hasn't really changed all that much for this company. Now let's have a look at the valuation metrics for Myer. If you thought this company was a high quality company, these numbers should probably excite you because the P ratio for Myer is 11.8. In fact, I think that is probably a little bit too high currently. I would prefer the P ratio based off their financial year 22 numbers would be lower or should be lower than 10. PB ratio, so price to book, is 2.2, and that is high historically for this company. So there is a little bit of excitement in Myer right now, and that excitement is pushing up some of these valuation metrics to the high end of the historical range for this company. EV to free cash flow. So this is one metric I do look for, and that is quite low at 4.3. 3. So if you just looked at EV to free cash flow, this company might be looking attractive in valuation. Also calculated a reverse or did a reverse DCF calculation. And this company doesn't have to grow to justify the current valuation. So in fact, it can go backwards at 7% per year over the next 10 years to justify the current valuation. So again, the market is expecting this company to go backwards from here, probably in terms of revenue, in terms of profit, in terms of cash flow. The company doesn't have any expectations for growth in this company. So I've already mentioned that the price to book ratio of around about 2.2 is historically high for this company. And this is the price to book for Myer since 2012. And back in 2013 or 2012 and 13, the price to book of this company was around 2. And then it fell as the interest and the wariness in this company was or reached a max back around about 2018 and 2019. And during COVID-19 financial panic, the price to book of Myer got down as low as 0.25, so significantly lower than it is now. And you can see the price to book since that low has been increasing, and right now at 2.2 is at historical high levels for this company. So just based off price to book, I would not consider Myer to be necessarily good value. But one thing going for Myer right now is the chart. There is some interest in this company, some positive sentiment behind the share price, and the catalyst for this positive sentiment or a shift in the sentiment was a trading update towards the end of July, and the share price increased 21% on the back of that trading update, and the share price has kept on increasing. So the share price right now is around about 70 cents, and that is at least a 1-year high, I think about a 3-year high, maybe even a 4-year high for this company. So even though the share price is moving up, and one of the things I am looking for in this company is positive sentiment and the share price in an uptrend. But at this point in time, I'm a little bit wary just based off these valuations and just based off, I think this company is or will be experiencing some headwinds over the next few years as people start to spend less and less, particularly if interest rates remain elevated and all those mortgage owners who are on fixed rates and then they convert those fixed rate mortgages to variable, they're going to have to start paying massive amount of mortgage compared to what they're paying now. I think there's going to be less spending in the economy moving forward over the next few years. And that's absolutely what the Reserve Bank wants. They want less spending because they are so afraid and scared of inflation. And that could have a negative effect on Myer. So I'm a little bit wary about Myer moving forward from here. I think there is potential. This is just a short-term hit to the share price, and wouldn't be surprised to see the share price fall quite a bit from these levels. And when I say the share price will decrease, I'm not talking about tomorrow, next week, next month, or even 6 months from now. I'm talking about multi-years in the future from right now. Share price could keep going up from here. For how long, who knows? And the whole point of these low-quality companies is you just ride this positive sentiment until it turns negative. And when that shift in sentiment comes, I have no idea. Now, I plan on doing these financial year 22 results video for a while yet, and the next 5 companies I hope to do a video on include Wesfarmers, Hansen Technologies, LaserBond, Fortescue, and Domino's Pizzas. If you have a company you'd like me to do a video on, just leave that company in this or the name of that company in the comment section of this video. Preferably, I would like to do videos on companies that are profitable. Doesn't have to be a high or large cap company because LaserBond is a small cap, market cap of less than $100 million. But that company is growing and is also profitable. So leave any suggestions in the comment section of this video. That's all I have for this video, looking at Myer and their financial year 22 results. If you have different opinions than mine, if you think Myer is a high quality company, if you think this company is completely undervalued right now, I'd love to hear from you, because the way we grow as investors is to take aboard different opinions. Doesn't mean we have to agree with those different opinions, but just listen to them. And maybe if they do make sense, we can change our opinion. And not only is that true for investing, that is true in our personal lives. We always have to take a look, listen to different opinions than our own, and that is how we grow as human beings. And that is how we become better human beings. Anyway, so if you disagree with me, if you agree with me, if you have any questions, just leave those thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.